in the longer term, the commission issue should also not be a problem for the AIF managers or the investment managers, so to say.
Yes, absolutely. Absolutely. Over the long term, it will not have so much of an impact, because in effect, like today, how in mutual fund we are paying, and we are used to the concept of paying trail fees and no upfront. When that happened, on the day when it happened, or near term few weeks, everybody was worried that this will completely stop the entire flows in mutual fund industry. But now that day is there and today is there. Basically, we are seeing healthy growth of the industry, good flows coming in. Likewise, similarly, even though it will move to all trail model, I believe very strongly, as you very rightly highlighted, that based on the NAV and the valuation of the flows, of the assets under management, the amounts will keep changing, but still it will be an ongoing steady income flowing through from the managers.
Okay, we take that point, and this is something that we had to discuss with you, since it is something that has come today itself. But generally, now we'd like to talk about the categories and a lot more in general when it comes to mutual fund industry as well, because we start with the new financial year, and the last week of FY23, of course, was overshadowed by the changes with respect to debt taxation. So I thought it's a good time to take a look at how different categories of funds have performed in the last 1 year. This data is, of course, as on 10th April and taken from Value Research. So let's start with the equity segment. The returns definitely not inspiring, and that is not surprising going by what we saw in the markets, right? On an average, equity large cap category has seen a decline of 2.4%, flexi cap is down 2.3%, multi cap has fallen is lower by around 0.57%, mid cap and small caps also saw a decline. ELSS as a category too hasn't done well, with declines of 1.18%. Now, if we look at the sectoral funds, banking funds on an average have given returns of 8.8%. Infrastructure has been good as well at 6.6%, but we cannot say the same about pharma and technology funds, right? Tech funds have declined 17%, pharma is down by 7.5%. That's across all the mutual funds. This is the average. In terms of thematic themes, consumption has been an outperformer in that regard, up 3%. But for energy, ESG and funds investing in the MNC stocks, they have not seen great returns. But PSU funds have done well. Dividend yield funds, they have seen flat returns. Now look at the debt category. We will see green across the screen. The segment in this category has seen positive returns overall. But important to note, these returns are still lower than inflation, and real rate of return is negative for them, because increasing interest rates lead to a decline in bond value, and that is what impacts debt funds in the longer term. Hybrid funds, they have also done better than pure equity, with arbitrage at 5% gains. We have seen balanced hybrid seeing gains of 2%, equity savings at 2.2%. Now remember, we are talking about a scenario where equity as a class has not done too well. Ending this with the star performers, of course, commodity funds. If you invested in gold funds, your portfolio would be shining, because this category has seen returns of 16% and silver is higher by 11%. So that's basically the synopsis, Pavitra, of what's happened here.
So interesting to look at it, right? The complete snapshot of what has done well, what has not. So let's actually pose some questions to Mr. Gilani as well on this. Like Sonal was pointing out, equity has clearly not been the best performing category this year. Not surprising at all, considering what's gone down with the markets. But what is your sense on how should an investor really position themselves now in terms of someone who's an existing investor as well as someone who's, a completely new investor into the market? We all talk about how mutual fund investing is a longer term kind of plan. You shouldn't look at just 1 year returns. But any thoughts on how both of these categories of investors should approach it?
I think very perfectly highlighted this point. So today, India market was amongst one of the most expensive market in the whole of calendar year 2022, trading at a premium to most of its emerging market peers. Now, if we see, let's say our Nifty 50 index, today it is in the 18th month of overall consolidation. It had first made lifetime high of about 18,500, October of 2021 last year. And since then, almost about 18 months, it has been a broad range. So it did make a fresh lifetime high in December 2022 of 18,700. But then today it is down about 5% from peak. But now if we look at from an individual investor's perspective, what, to your question that should an investor do now? What should I do with my money if I'm first time investor? See, if we look at the underlying valuation. Now in these 18 months, we have seen the Nifty EPS or earnings per share has grown up almost 30% from 650 rupees to 850 rupees. So because of that, the P ratio or the price to earnings of Nifty has been declining consistently. It had risen to around 28 times. It is down to now 21 times approximately. Similarly, price to book, which is another measure of the valuation, is down about 50 basis points to 4.20 from around 4.70 at the peak. These are all based on historical trailing earnings. So I feel that during this period, as of today, index and overall equity markets have gone through a consolidation, but with rising earnings as well as price normalization. So it has become more attractive to enter. Hence, in my view, if you are an existing investor, these are the times, in fact, where you should keep adding exposure in this kind of sideways and sort of like consolidating markets, because systematically this will be a good time when you look at it in hindsight, that this was a good time for accumulation. This could be a part of a secular bull market in equities. If we are a first-time investors gradually starting to come into equities, then maybe I would suggest a little bit combination of equity and fixed income, or let's say in simple form, just buy a hybrid mutual fund, which will give you exposure to a little bit equity and fixed income. No doubt. So I feel market is considerably in a good valuation. However, certain risks will be there. We should look out for certain sectors which could be impacted by side effect of sharply rising interest rates, which have happened from last May over the last 8 to 12 months. So this is something which we need to be watchful of. But broadly speaking, this would be good times to continue to invest into equities in a disciplined manner.
Okay, so now that we're talking about equities, of course, since the show is about mutual funds, the viewers here, of course, would look at, as you said, if they're new investors, they should look at hybrid funds. But other than that, if somebody is an existing investor, they could look at equity-oriented funds as well. In that regard, Mr. Gilani, what about index funds, so to say? Is that something that an investor should look at right now?
Very good question. And in fact, that's why I like this show very much. You guys always come up with very well-researched and timely things. So always good to engage on such questions. Today, in current market situation, like we said, especially when you want to invest into large caps, one of the best ideas would be to avoid complexity and keep it simple by investing in low-cost, passively managed index funds. Now, why so? Very often, sometimes we get busy with historical number crunching and highlighting that so many number of funds have not been able to outperform the index in the history. But I feel a little bit different. Let's look at different angle. Now, one interesting point to look at is what we call as cross-sectional volatility. What it means in simple layman terms is the differential of returns between the top quartile or top quintile stocks and the bottom quintile. Means the dispersion or the cross-sectional volatility in the shares within large cap universe. Now, in such scenarios of market where there is consolidation, we tend to believe that there will be a much lower cross-sectional volatility. Means the returns expectation of the best performing stock in the large cap universe and the worst will not be very high. Hence, actively managed funds will find lesser and lesser opportunities and find it more difficult to outperform the index. So I believe, yes, in such kind of market scenario, definitely index funds would be very useful, and investors should consider investing through index funds when they want to take their equity allocation.
All right, we take that point, Mr. Gilani, and at a time like this, we've been talking a lot about, like he pointed out, valuations have corrected so much. Across the board, we've been getting that buy India call from several brokerages, right? So maybe, like you said, this is a good time to just be building your positions and looking at index funds, which will give you good exposure to the larger names. We do have to take a short break, but I request you to please stay on because we have lots more questions. We're going to continue our focus on index funds and be back in just a bit.
Welcome back. You're still tuned into Mutual Fund Corner on CNBC-TV18, and we have Anil Gilani of DSP Investment Managers with us to answer all our questions about index funds and investing at this juncture into mutual funds as well. Mr. Gilani, we were talking about whether it's the right time to invest into index funds or not, and you said that yes, because of the valuations that we are looking at, and generally it's a safer bet to make for newer investors. Tell us, how are index funds and index ETFs different from each other? What should an investor keep in mind?
In terms of index funds and ETFs, structurally, you will have the same risk and return outcomes with just little different format of the vehicle you are investing. So let's say in simple layman terms, if you wanted to go from your home to your office, early you have two options. You can book old-fashioned way, call up like a kind of what used to have Miru cab. They will pick up the phone and say, okay, where are you currently? And they will send you a taxi. Versus, let's say, hailing a Uber through a mobile app-based taxi service. Both will give similar outcome. Air-conditioned vehicle will come to your doorstep and take you to the desired location, but with a different format. Similarly, both ETFs and index funds will provide you similar exposure in your portfolio. So then the choice comes down to your individual needs and your tech-savvy nature. So let's say if you are better suited looking for intraday pricing, you want to hold your investment in a demat form and buy through a broking platform, stock broking platform, then ETF is a better option for you. But let's say, for example, certain investors like us, sometimes we have restrictions in terms of having broking account and demat account. Or let's say certain investors, they have a little bit of a hesitation of using this kind of technology. Then maybe for such investors who want to just buy day-end NAV and hold for long term, index fund can be better suited. But in summary, both index funds and ETFs of the same underlying will give you very similar risk and return outcomes.
Okay, got that, and that really explains it. Mr. Gilani, now tell us, if someone is looking at index funds, what should they really consider before making such an investment? And are there people who you think this is really well suited for? You said new investors for sure. And are there also people you think perhaps this isn't the best choice for?
In my view, certain things which one should look at while investing before investing into index funds is that the key risk and return of your underlying. So today, just like you are investing into a particular equity share, you are looking at the risk and return. Similarly, even ETFs or index funds have that kind of a equity risk involved. So in terms of the strategy which you decide, let's say you want to decide and buy into a basic plain vanilla large cap strategy like a Nifty 50 or some innovative thing like a mid cap focus with quality factors. It is important to identify and make sure that the underlying strategy that you are investing in meets your risk and return requirement and your portfolio allocation goal. Now, once that is done, other things to look at before selecting which particular fund or fund house you want to do, you should look at things like whether that particular fund house has a key focus on passive funds, whether they have a dedicated team, what kind of number of schemes they have, how has been the historical tracking error and tracking difference. Certain times, this is more useful and more powerful to analyze rather than just looking at the size of a fund. Because in passive funds, I always try to say that the underlying is important. As long as the underlying is large, liquid and transparent, LLT, all three together, then you are comfortable, irrespective of the size of your scheme. So I believe ETFs index funds can be suitable for all sorts of investors. So to your second part of your question, are some people should not be looking at it, certain category? I would feel definitely not. I mean, depending on your requirement, where it can fit in your portfolio. All categories of investors will find it extremely suitable and in fact will find it new. Today they are finding it. Today we see a large number of investors already using index funds and ETFs for their allocations.
Okay, so that explains the difference between them and also between the two funds, and also what kind of risk profile and what should an investor look at while they're investing in such funds as well. Mr. Gilani, how are these funds taxed? Because at the end of the day, it's the post-tax return that one looks at. And has there been a change in terms of flows to these funds because of the change that we've seen in tax regime for debt funds?
Yes, very good point. So see, index funds and ETFs have a taxation exactly similar to any other fund. Unlike certain global markets, like especially in the US, there were certain preferential or special treatments for ETFs. In Indian market, we don't have any special or preferential treatment. So yes, absolutely right. When last month there was a change in the debt fund taxation, even the index funds which were debt oriented, they saw the change, whereby now there will be no debt based index funds will not get the indexation benefit. So yes, that has undergone a change, and maybe because of that, in the incremental couple of months or so, we could see a little bit lesser flows in debt index funds. But like we said in the first section of discussing about the new circular, any such new regulatory or tax regime changes gradually gets realigned, and then life becomes readjusted to the current base. Since we spoke about debt related taxation, we might remember a couple of years back when debt taxation had changed from 1 year to 3 years. At that time also, for a short term, flows had slowed down, then gradually everything started like normal. So I believe here also there is a possibility in the near term, maybe a couple of months, debt funds will see a little bit slow down, but they will normalize. Funds which are investing in equity as an asset class or commodities, let's say for example gold and silver, these would continue to see their flows, and there is no change in the tax treatment for that.
All right, got it. And with that, we are going to wind down on this edition of the show. So thank you very much for taking out the time and speaking to us today about, this recent development that has come through on AIFs, as well as a full picture on index funds and how you can really go about investing.